Welcome back, everybody. It is great to have you for another episode of Bridging the Gap to Web3. I'm one of your co-hosts, Connor Boundy, here with Luke Pillarella. And man, we just had an awesome episode. We were talking about evaluating and financing disruptive companies. We had two wizards on with us, Tien and Sebastian, that were dropping knowledge bomb left and right. It was an awesome episode, everyone. So I hope you're excited for today.
Yeah, I couldn't agree more. It was a great episode. It was great to get their insights across their variety of different experiences. Tien bringing both his entrepreneurial spirit as well as wearing his investor hat. We had Sebastian, who's more of a corporate entrepreneur, as well as a venture capitalist in more disruptive technologies like Web3 and artificial intelligence. In this episode, you're really going to be able to get their perspectives on how they perform due diligence with startups. What are some of the red flags they look for? What are some of the green flags that they look for? And what are the tangible, actionable insights that you as founders, entrepreneurs, or other investors can take away to implement in your day-to-day operations and activities?
So I hope you guys get ready for a big episode today. Get your notebooks handy because you're going to be taking some notes, and hopefully you have a few things that you can implement into your companies or into some of your future investments. So go take a listen, enjoy, leave us some feedback in the comments, and make sure to like and subscribe to Startup Grind Local. We will be posting episodes here in the future every month or so. Stay tuned and go enjoy. Thank you, everyone, for joining us here today. I am looking forward to another awesome episode of Bridging the Gap to Web3. We are here for episode 8 with two incredible guests today to talk about evaluating and financing disruptive companies, which I think is going to be a super interesting topic. We have had a lot of our listeners asking us about this one, so cannot wait to dive into the details with all of you. But before we do, I've got to introduce myself. My name is Connor Boundy. I'm one of our co-hosts and co-founders here at Atlantis Capital, along with my other co-host, Luke Pillarella. We're going to dive into things with everyone today, but we have to give a huge shout out to our sponsors that have helped make this all possible. We've got a huge group that has, helped put this series together behind the scenes, and without them, we wouldn't be here. So bear with me while we go through the list, but huge shout out to, the teams over at Startup Guides, Safe Haven, Dominant Creative, VChain Foundation, Mad V-Apes NFT, MetaJuice, ABC FinTech, Industrial Outdoor Ventures, BHR, Data Nexus, Cut on the Action, and Rare Network. Luke, that list is getting long, man.
Yeah, it's getting long, and it's great to be back here for episode 8. I really hope that all of our attendees joining are having a good start to the holiday season as we're getting into the December months here and wrapping up the end of 2023 and getting ready for a good 2024. As a quick recap for those that are tuning in maybe for their first time or joining us again, our last episode 7, featured 3 amazing guests. One, Matt Verkler from Cut on the Action, and 2 individuals, Wes and Rand from Rare Evo Network, both of them kind of helping us navigate the waters of the event and production industry, which is an industry that I didn't really know too much about, but they shared some great perspectives, great stories, and just overall help to educate us around where that industry is going next and really where we're coming from. So if you weren't able to tune in to us last episode, definitely go out there. All of these episodes are recorded and viewable on YouTube. Find us out there at Bridging the Gap to Web3, a Startup Grind Local Maryland chapter. Like, share, comment. We'd love to hear from you and enjoy to hear what topics you want us to talk about next.
Yeah, that last discussion was fascinating, man. I don't know about you and our listeners, but I didn't know much about where the events industry is really going when it comes to technology transforming it. And hearing how, the NFT landscape is revamping, how teams are going to be engaging with communities, and how new technology is really just helping in terms of VR and AR interactions, where if people can't even be at the event in person, they've got a new way to interact virtually. It's just been fascinating. And we're just going to continue the discussion today with 2 incredible guests who are probably going to teach us a lot, man. I know we've been, investing and evaluating these disruptive companies for some time, but these 2 individuals, they've got not only incredible experience on us, but the stories they're going to be sharing here and the stories that we've gotten to hear already, we could have probably 3 episodes about this one.
Yeah, I couldn't agree more. And I definitely am excited to dive into the questions that we have, interact with our audience on the line, and really get to the nitty gritty of some actionable insights of things that we can implement, tomorrow in our day-to-day activities. So, with that, I think we set the stage well, and I'm really excited to bring up our speakers for today, and we'll do a couple quick introductions, and then we'll get right into the episode. So to kick us off, our first guest is Mr. Tien Wong, who is a distinguished technology entrepreneur, CEO, and an angel investor. Tien is the founder and host of the globally renowned Big ID Connectpreneur Forum, which is a global community bringing together founders, investors, and business leaders. Additionally, Tien is chairman and CEO of Opus 8 Inc., where he truly specializes in strategic advisory and raising capital for tech companies. With a proven track record, Tien is a very respected industry expert and advocate for entrepreneurship and innovation. So audience, please join me in welcoming the visionary Tien Wong. And Tien, it's great to have you, and welcome to Bridging the Gap to Web3.
Thanks, guys. Really appreciate it. Looking forward to the conversation tonight.
Absolutely. And our second guest is Mr. Sebastian Spitzer, another dynamic innovator and corporate entrepreneur with a background in innovation management and ecosystem building across multiple sectors. Sebastian has led the foundation of several in-house startups, experiencing both setbacks and 2 successful internal exits, which is awesome. And currently has transitioned from an operational role to more of an investor. Sebastian now collaborates with the Scheffler CVC team, focusing on sourcing startups in auto tech, SaaS, and industrial deep tech. Passionate about mentoring early stage founders, he currently advises 2 investment funds, delving into the realms of early stage Web3 and generalist ventures. And during his downtime, Sebastian enjoys exploring technologies like GPTs from ChatGPT and creating innovative projects and connecting with nature. But Sebastian, it's a pleasure to have you join us, and welcome to the episode today.
Thanks for having me.
Well, gentlemen, Luke went through the background. There's a reason we're excited. You two have incredible backgrounds that honestly, most entrepreneurs would love to just get in the room and pick your brain with, because you've seen so much. And, Tien, I'd love to start with you. Can you tell us a little bit more first about Connectpreneur? And what you and your team have been up to over these past few years.
Yeah, no, absolutely. Thanks, Connor. It's a pleasure to be here, and congratulations on the podcast. I think what you guys are doing is filling a real big gap in knowledge and bringing a lot of great thought leadership to the table to help people navigate the Web3 sort of maze. Connectpreneur is a community. It's a global community of 85,000 investors, entrepreneurs, and service professionals from around the world. We tripled our headcount since the pandemic started, and we run the world's largest virtual investor pitch event that's done on a monthly basis. So we help companies connect with entrepreneurs and with investors. We've had 1,200 presenting companies over the last 13 years. We're going into our 13th year now, and about half of them have received capital and funding from investors that they met through our platform. So we have 1,200 alumni. We have another 1,000 companies that want to present over the next couple of years. We're back to doing 8 in-person events per year, and we're doing 12 virtual events, 1 a month, although we might scale that back in the coming years. And we're hoping to do some Connectpreneur programs in California and Texas, because we have quite a few of our alumni are in those markets. So that's a little bit about us.
Well, if you come to Chicago, let us know.
We have been talking to Salt Flats and some others about doing something in Chicago, so I'll keep you posted.
Love to hear that. It's safe to say that you've seen maybe a couple disruptive companies over the course of those evaluations and, funding waves. I've got to ask though, I'd love you to take us back, because obviously you've seen the waves of these, companies come through, and you built a lot of experience in terms of what to look for. But can you tell us about what that first time was? When you're looking at a company, you're deciding, hey, I think I want to invest in a startup and help them grow. Can you tell us about that?
The first time I was in my mid-20s, and then again in my mid-30s. And then after I sold my company, I started making more investments. The first 4 or 5 companies had one thing. If I had to think about what they had in common. They had a founder that I really knew. I either knew them well or I had a great feeling about them. And it's hard to quantify that, but people I knew that they had a similar value set. They were focused on customer. They were, super hardworking. And yeah, they may have been disruptive. In some cases they were, and in other cases they were not. But I was sort of betting on the jockey. And basically, made about almost 30 investments. And I would say almost all of them we bet on the jockey as opposed to the market or the technology or, other reasons. So I think that's just a personal, we're not an institutional investor. So it's based, when you're talking to angels or angel groups, small family offices, you're talking about investment criteria that are developed by the founders, the guys that made the money, that are deploying the money. What do they like? What flavor of investing do they like? So my particular flavor is I like to bet on people, literally. So
I mean, I think
I wish I had some science behind it, but a lot of it's gut feel too.
No, but I think Luke and I are right there with you. I mean, Luke, I know we always talk about it when we're looking at teams. It's always who's the person behind it. Because as much as it's awesome to, invest in really cool technology, to invest in something disruptive that's changing how we're doing things, I truly want to enjoy working and rooting for that person. And I think that that's something that has been really interesting to see the take of, different investors kind of weigh that in completely different ways. And it's interesting to hear that you have that pretty high up on your weights in terms of how you look at companies, because like I said, I think we're in a similar boat. And I guess I'd love to turn it over to Sebastian. Obviously Luke went through your background, man. You've got a crazy journey into venture capital and just exploring everything as well. Can you tell us about how you began investing in your first company, and what that looked like?
Absolutely. For me, it kind of came as a natural progression. So I've been in innovation management for the last 15 years throughout like 3 different verticals. And the way I always approached it was always following lean startup principles and design thinking, right? So textbook, treating every idea within the company as its own startup. And it's interesting how many parallels you can actually draw if you set it up that way, meaning I always applied for funding from C-level executive board and basically assembled my team. So it was the same process that every entrepreneur has on the outside, just within a company. And I got my team and my funding from the C-level instead of like external investors. But it's still the same process, right? You have to turn an idea into a business concept. You have to pitch it. You have to sell it. You have to convince people that they give you resources. And so I did that throughout a couple of verticals. And over the last 7-8 years in the automotive industry, all of that involved to work with external startups as well, because for some of the ideas, for some of the innovation concepts, and for some of the technologies, there wasn't enough competence in-house, right? And it was like new disruptive fields. So I sort of like splurged into startup ecosystems at large, fulfilling roles as like a venture partner, venture clienting manager. And through that, and like through being exposed to like startup ecosystems, I also ended up in Web3, which was 2017. I think, yeah. So 6 years ago, and the technology really caught my interest, and I truly was in it for the technology. I know that everyone sort of says that, right? Like
we're quoting that. That'll be the snippet that we push out for this episode. In it for the tech.
in it for the tech, and stayed in it for the tech, right?
Yeah.
Awesome. I mean, I know that everyone said that after the Bitcoin price went crazy and through the roof. Out of a sudden, everyone was a Web3 specialist and everyone was interested in blockchain. But for me, it was actually really starting in the automotive industry. So I was exploring how the technology can be used for automotive, and there was like concepts around supply chain. There was digital identities for cars, right? And I sort of really was like drawn towards the appeal of the new technology and like what it enabled and what it stood for, aside of all the memes and like the price developments. But back then it was just too early to apply it for an enterprise setup. It was not stable enough. There was a lot of friction. So I stayed in the space in my spare time and on my own dime, and that's also how I first started investing, right? So, like Tien said, I applied my knowledge and my background, and I started angel investing. And for me, it also was mainly into founders and mainly into the jockey. I actually love that analogy, and it's because, right, you first and foremost invest in people because you want to have the conviction that they stay on that idea for the next 5 or 10 years, and it actually becomes a relationship with them. And the earlier you go, the less you know about the market, the product, and a lot of things change. I mean, I would assume, honestly, about 95% of the companies that you see right now that became unicorns or were extremely successful did not end up scaling the product that they initially started with. So
100%.
there is a lot of change. So you want to believe that the team and the founder has the capability to react to customer feedback and react to market changes and to the dynamics, and just turn an idea around. And like, that doesn't mean that they have to like ditch the vision, but it could mean that if they just see that whatever vision they pursued at the beginning just doesn't stand on legs and like doesn't meet market demand, right? But anyway, like before we get too much into that, so that's also my philosophy. I also like to invest in people, more so than the market and the technology. But yeah, for me, it started in Web3. I did like 2 investments as angel investments. Then I became advisor to those investments. Then I started working with a VC company within the Web3 space for a good 4 or 5 years, like supporting them during deal flow, meaning sourcing deals, running due diligence, and then writing the tickets. So did that for like 4 or 5 years in my spare time. And that all of that like accumulated into me now being active with our CVC team, looking at industrial deep tech, looking at like startup companies for the automotive space, and still doing my angel investments on the side and like looking at early stage startups on my own dime, basically.
It's so awesome. I mean, both of your journeys are just incredible. And it sounds like you have a similar view as well, where you're betting on that, jockey, as Tien would say. It's that perfect blend of people, technology, and process that helps that startup really go from 0 to 1. You can't have one without the others. That relationship has to exist. And especially with these giant disruptive companies, if you don't have that person, that jockey that's behind it, that's pushing it forward, help drive that technology, disruption, it's tough to do. It's a long journey, like you're saying. Is this person going to be in this for 5+ years? Or is after the first hurdle and first pivot, are we going to see us close shop? And so I have very similar feelings as you and Tien both do with how you kind of look at supporting the people behind this.
Yeah, I can't echo it any more than what's been stated, but it's just like anything else. This journey that we're on is a lot of ebbs and flows, ups and downs. It's definitely not straight vertical and to the right. And so throughout that, there's going to be changes, and therefore that person at the helm is going to need to be able to dictate which direction to go, whether it's pivoting, whether it's doubling down, or whether it's scrapping, the initial plans. And so with kind of all of that, I kind of, Tien, I want to go back to some of this journey that you've been on. You said that you started kind of investing in, kind of your mid to late 20s, currently in the stage that Connor and myself are in, right there at the beginning. And you've seen maybe, 10s, 20s, 30 more investments since then. So I'm curious, how has investing in startups changed over that time period since you've started up until maybe your last investment? Has it changed that much, or is it the old adage of nothing's really changed except for the names?
You mean has it changed for me as an investor, or more has the market changed?
Both. How about we start with you as an investor and then the market perspective as well?
Yeah. So well, every time I lost money, I learned something. So
expensive mistakes.
Exactly. It's tuition. It was tuition. I mean, don't get me wrong. I've had some great wins too, but you lose a little bit here and there, and you kind of realize, you kind of, you pivot your thinking, you change your thinking and adapt it depending on, lessons learned. So for me personally, that's sort of been, the big theme for me is investing outside of areas that I don't have a decent knowledge of. I kind of looked at the deals where I didn't do so well or I lost money, and it tended to be that, like I was an entrepreneur. I built a business, I sold it, and I'm sitting on all this investment capital. And of course, I don't know anything, right? And I still don't. But at the time, you don't really know what's going on. But every deal looks good, so you sort of sprinkle it around, and you afterwards, it's easy to Monday morning quarterback all your mistakes. It's so easy. But so you kind of take these little lessons and learn from it. For investors on this call and elsewhere who are, I believe very, very lucky, the biggest change I would say since I invested my first deal like in the late 80s. That's ages ago. I feel old with you guys here. I'm telling you, I'm probably older than your parents, but it's okay. But the thing of it is like you have access to information it's unprecedented. Not only do you have access to information, you have access to analysis of information. I'm not just talking about AI and ChatGPT, but the flow of information is never going to be perfect, but it's a hell of a lot more perfect, 50, 100 times more perfect today than it was, before the computer age, before the, back in the 80s and 90s. So I think that gives investors that are really smart a great advantage. They can diligence deals better. They can analyze customers better. They can cut through the BS a lot better. And, you can really de-risk a lot of the checks that you're writing, I think, today than you could have 20, even 30 years ago.
Yeah, that's a great perspective there. And I'm curious, I want to double click real quick because Tian, I'm just not too educated on how did you get that information back in the 80s and 90s? Like what would you do to kind of perform some of those due diligence? Because today we can go out, Google, ChatGPT, Bard, whatever else exists today from access to information. Curious.
Well, okay, so I was no different. Okay, so some things don't change, right? So why did I invest in that one company? It was in Europe. So I don't know jack about Europe, Eastern Europe, which was liberalizing. I didn't know anything. But the guy that was running it was a friend of mine. So that was one thing. And he got Esther Dyson to invest. And you guys probably don't know who she is. She was one of the queens of technology back in the day. So when I saw Esther had written a check, I was like, okay, she knows something. And I just went ahead and I played follow the leader, which is what a lot of institutional VCs do. People will follow Tim Draper. We talked about Tim earlier. If a big name VC goes in, then all the little guys line up behind them because he knows something, right? Or she knows something. So that was sort of my justification for the first opportunity. So really, there's no science to it, really. A limited amount of analysis as well. A lot of it was gut feel. I feel like the industry in the 80s and 90s, the VC industry, even before the crash, even right after the crash, I think a lot of these guys operate on gut feel.
It's crazy.
It's more of an art than a science. I don't know, Sebastian, I would love your perspective on that.
Yeah.
Like how much of it is science versus art,
Oh, I love it. Yeah. As you were just talking, I think it's largely dependent on the stage of the startup, right? So the earlier you go, the more of it is art, and the later you go, the more the science comes into play. But still, a lot of it is still art, right? I mean, at the face of it, and ultimately, it's certified gambling on a future market, right? That may or may not exist, and I know a lot of people would disagree, and everyone is like, oh, but we do this process, and we have due diligence and all of that. But especially in early stages, like when you look at pre-seed, seed, most of it is gut feeling. I mean, as we said, right? You invest in the people, you invest in good faith that this team will be able to overcome any obstacle that the market can throw at them, and you also try to predict customer demands and market demands in 5 years or 5+ years actually. And I mean, a lot of things can change in 5 to 10 years, right? Look at regulation, look at technological advancement, and it's the same in AI right now. Actually, we can use AI as a good example, right? So right now, my investment credo is, and this is me speaking personally, is for any angel investment I might do. How big are the chances that OpenAI will just disrupt it and do it themselves. It happened like at least like 5 times with startups that came out over the last 6 to 9 months. And what's crazy is Luke was asking like what changed over the last 30 years. I think a lot of it is still art and gut feeling, especially at early stages. What changed is the velocity and the dynamics, and that changes for investors and for founders alike. It's crazy how fast you have to pivot sometimes and how fast you have to make decisions. I mean, looking at those AI startups and like the GPT wrappers that came out over the last 6 to 9 months, right? Like a lot of them went completely obsolete within 6 months because now the big LLM providers provide their service as an integrated solution to the large language model.
Mm-hmm. No, absolutely, absolutely, and I think we get some really good perspectives here on from the investor lens. What are you focusing on, and really how has that changed? And I do think that it's great to call it an art versus a science, and it's collaboration of both, right? I know for Connor and I, we're definitely pre-seed, seed stage investors, and that's what we like to look at, and it's much more of an art there, a feel, a gut feel, a founder that you really enjoy, that is going to carry you for the long run. But I'm curious. Let's shift perspectives a little bit, and now let's almost put ourselves in the shoes of the startup founder, the entrepreneur. So Tien, I know you were an entrepreneur. Sebastian, you were an entrepreneur, so you kind of have this perspective as well. And Sebastian, we'll start with you here, but what challenges do you see from the startup lens that most people run into when they begin to fundraise? Is it that they don't have a deep enough understanding of the industry, they don't know their customers well enough, some combination of the two? What do you really see as those main challenges as a startup founder when you're looking to fundraise and get your first capital allocation to your business?
Yeah, I think the first thing, well, like one of the first challenges is actually finding the right investor, right? I mean, if you are in desperate need of money, any money looks like good money, but that's not necessarily the case. Especially if you're early on, you wanna find investors that grow with you. And as Tien said, if you are an investor that goes both ways, you actually want to invest in something that that you understand, ideally where you have competence or where you have a network. And that goes for the founder as well. Ideally, you want to find an investor that can actually help you scale through the network, through their connections. And when I broke first into VC, and like when I was trying to understand how this whole industry works, it's almost like this like secret stonemason club, right? Like it's sort of like, honestly, that I think there is hardly any other industry that is so relationship based and so network based than the VC industry. And it takes you a couple of years to really grasp the magnitude of that. I mean, how do VCs get deal flow? Like we talked about Tim Draper. Like if you have a good name, you hardly have any like outbound deal flow requests. You all get it inbound, and like where do those recommendations come from? From other angel investors, from other VCs, from founders who you invested in that then recommend other founders, and then basically make you warm intros. And that's another thing. I mean, right now the fundraising environment is brutal. Like even though we now see some green candles in the crypto markets. And generally, like the Nasdaq and like all the traditional public markets made a significant uptick over the last couple of months. But don't let that fool you. I mean, all of those markets are reflecting predictions of the future, right? But the stock markets are usually like, I would say, predicting what happens in the next 3 months, whereas the VC industry is trying to predict what happens in the next 5 years. Yep. So the perspective and the longevity of the prediction is a lot longer. And there is a lot of dry powder, and that is good, especially if you're on the early stage. But it's extremely hard to get funding right now. So right now, really, traction is key. You want to have something to show for. It's almost impossible right now to raise money just on a pitch deck. Like in the heydays in 2021, especially in
a cool deck. Yep, cool deck and cool demo. That's all you needed.
100%. Like you would have been able to like get funding even from actually well-known VCs, and I was actually surprised by that. But in the heydays when everyone wanted to flock into an industry like Web3 and when everyone wanted to have a stake in it, right? Like sometimes all it took was like a half-ass pitch deck and like some good marketing and sales, and you were able to get funding. I think that environment has dramatically changed right now.
Yep.
And it's really hard to get funding, and you want to definitely show traction, which sometimes can be extremely difficult, right? Like, I mean, I mainly look at deep tech from a professional side, meaning industrial deep tech, robotics, hardware, things that take a lot of capital and time to scale and to get traction. So sometimes it's really difficult to like show traction and like actually define the metrics that define traction, right? Like, so you just have to be mindful of that and like find clever ways, even if you are early, to show why people would care, right? Like, even if you don't have revenue to show, find the metrics that turn a gut feeling into a semi-fact and make people believe that what you're building and what you have there is actually demanded by the market, and then you will find customers. And what's interesting about Web3, if and I'm going to end on that note and pass it over to Tien. If you look at like the traction metrics of Web3, they are vastly different from Web2, right? Like Web2, it was like SaaS was ARR, revenues, customer growth, LOIs, and traditional metrics of any company. And in Web3, it mainly went into like TVL, like number of wallets, transactions, ecosystem size, developer activity, engineering activity. And I honestly think like also if you're building in Web3, be prepared that investors, well, one, there is more investors coming in from the traditional world into Web3 right now, and it's like sort of like mixing everything up. But two, since we've seen that a lot of Web3 companies failed to actually turn their idea into an operational business that makes money, be prepared that investors will increasingly ask you about actual hard metrics on your revenue, on your users, because just having a token and just having a token price that does 10x is not good enough anymore, because ultimately you have to pay salaries, you have to pay bills, and you have to build a company that lasts over the next 10 years by actually making operational revenue.
But it's that chicken and the egg scenario with that, where it's like, especially in deep tech and Web3, sometimes you need that funding to develop this crazy disruptive technology and build this infrastructure. And how do you get that funding without having users? It's that weird kind of middle ground. And that's why I think it's such a tough time for these individuals that are raising, right now in this environment, because everyone wants to see traction. And sometimes you need that little bit of pre-seed funding or, just a small round to develop that beta product or that first solution that can start to get those users that these investors are asking for to launch these giant checks. And so it's such a difficult time right now, but I can definitely relate to everything you're saying, Sebastian.
Yeah, especially now too, I think a lot of startups who are starting now have looked back on the last, 20, 25 years. And from a macro perspective, we were at low to 0% interest rates. So it was rather easy to get additional capital for your businesses without necessarily having to prove that traction or those metrics to really demonstrate that you have a viable product or a viable service offering. So I think that those are some really valuable perspectives, Sebastian, that you added there. Tien, curious to toss this over to you, as what were kind of, especially you being a successful entrepreneur, right? You were able to take an idea to a product to market and eventually have that successful exit. What were some of those challenges that you faced, and what are some of those challenges that you see early startups face when they're looking at raising capital?
Yeah, I mean, I want to echo everything Sebastian had said, which is I couldn't agree more, especially with the fact that I think since 2008, this is the toughest funding environment I've seen since before we even started Connectpreneur. I mean, you mentioned rates going up, the market crashed 18, 20 months ago. It's been a real winter, and whatever the public markets do drives what private equity does, and that drives what B and C round players do. It just flows downhill, A round, pre-A, seed, So it just affects everybody. Unfortunately, it's a domino effect. Exactly, Connor. So I don't know when we come out of it, but you said one thought I wanted to bring up about an entrepreneur would face is that they got to stay positive and stay persistent, because I think that it will come back. We've seen it come back. I've seen it come back many times. And it will come back. It's just a matter of when. And I think we're getting back to sort of basic metrics of valuation and basic metrics of investment, which is the fact that the money was crazy 2 to 3 years ago was because the stock market was crazy, and that's sort of down. And I think we're getting back into sort of rationality, if you will. So that means the best deals get funded, and for now. And then the guys that don't have the best deals, just hang in there, just keep hanging in there. And then eventually the rising tide will lift your boat, So that's something to think about. But remember, institutional investors don't make money unless they put money to work. They get their 2 and 20. So if they don't invest, they don't get 2 and 20. So they will be investing. Maybe they're going to invest in less risky deals right now.
Yeah.
But yeah.
But they still have to deploy capital, right? That's the business that they're in at the end of the day. So there's going to be money at work, and it's just my brother has this good analogy. Tian, you said it too, but it's at the end of the day, startups are like buoys, and what you try to do is just wade the waters. Some waves are going to be high, some waves are going to be low, but all that matters is keeping above the wave line. And that's really where we need to be going in this environment.
And I love, Tian, that you were just saying, be positive and, kind of stay consistent in your mission, because I feel like that's a term that's been thrown around, at least in the Web3 world, a lot more. Is everyone's like, oh, we're in a bear market. We're in a bear market. Founders have been calling it a build market, because it's like, hey, now we have the time to actually focus on our solution rather than be this marketing engine that's answering when is the next thing coming. And so it's been a very interesting shift to see some of these teams go from these giant marketing engines to these, building teams to actually move forward.
Yeah, building teams and building product and focusing on customer needs, as opposed to trying to create a shiny object that attracts capital. You're attracting customers now. So if you can attract customers, the capital will come. Whereas I think 2, 3, 4 years ago, people were trying to do whatever it takes to get the money. So that's sort of a difference in sort of the paradigm shift,
Exactly. And I think that's one of the big, red flags here that everybody kind of looks at when they look at the last few years of investing in Web3 companies is we invested in these giant marketing engines that after you lifted up the hood, there was nothing there. It was a really, really shiny idea that had a vision that was 10 steps away, and we had not even started step 1. Really cool in theory, but the execution just wasn't there. And so I'm curious, Tian, I'll toss it to you first. What are some of the red flags that you're looking for in startups? It looks like we've even had some people asking questions about that in the chat. We've talked a lot about the flags, but what's the red flag that comes across the desk?
Yeah, so Sebastian and I both talked about the people side. So of course I default to that as far as my primary analysis. And the biggest red flag for me is an unconscious founder. And what do I mean by unconscious? Someone who is not aware, and they're not aware situationally, and they're not aware of themselves. They're not self-aware. That affects their ability to adapt. As you know, Darwin said it's the survival of the fittest, and fittest doesn't mean biggest and strongest. Fittest means most adaptable.
Absolutely.
How can you adapt if you don't have that internal diagnostic, that self-awareness, that situational awareness that allows you to pivot? Somebody mentioned earlier that some of the great companies of this world, Facebook included, they are not where they were when they originally started. They pivoted multiple times to get where they are. So that's why you need a founder who has that awareness, that ability to recognize when they're, the effects that they're having on the markets, on their customers, on their employees, and be able to, recalibrate and improve. I think that's the first thing. And that's very hard to diligence, kind of hard. You have to spend time with the founder and sort of get in their brain a little bit and see what kind of personality they have. But I know it sounds trite, but I think that, investing in a founder who's self-aware, who's likable, who's focused like a laser, and who works their ass off, that's table stakes to me. But if they have that ability to self-diagnose and adjust, that's a good one, So if they don't have it, that's a red flag for sure.
Couldn't agree more. I mean, I think one of those things that's rare is when you've seen a startup that has already pivoted and then they're coming to you for, a funding round to go and take this new pivot to the next level. It's kind of, again, goes back to that, theory. Are they an unconscious founder? I love that term, by the way. Luke, we're writing that one down. Of just, are you aware of your environment? Do you know what's to your left and to your right and how you're getting ready to even tackle your market? So that's so interesting. And Sebastian, I assume that you have a similar view as well, but any red flags for you that kind of come up when you're looking at a team and you go, ooh, do not like to see that?
Yeah, it's interesting. I mean, I think there are some textbook red flags that everyone could just Google, right? But it always is extremely situational, and no startup is like the other. Like, I mean, it truly is always unique because you always have a unique combination of founding team, product, stage of product, and the market that they are trying to address. So I think trying to, let's say, generalize and basically have this vanilla process that you follow to a T is extremely hard and sometimes not really efficient. But I would second what Jan said, and I had the same thing in mind. What I've noticed over the last couple of years, also like working with Startup Bootcamp and working with a couple of like incubators, accelerators, and seeing that, I think a red flag is if a founder or founding team will not accept any advice. And hear me out. Like advisors weren't born with a golden spoon, right? Don't just blindly follow them because they say they are an advisor. But it ties exactly into what Tian said. So if you have someone with a certain like domain authority who's maybe seen a couple of startups already, who's been in the VC game for quite some time, or who's been in the vertical that you're trying to address for quite some time, chances are they have 5 or 10 years of experience and they know some of the market dynamics, right? So saying like if you completely ignore any advice, that's exactly as ignoring the feedback that you get from the market. But the good thing about an advisor, ideally, you don't have to make the mistake on the market first. You actually can even get that knowledge from the advisor before you make the mistake. So Exactly. It saves you time. So if you are incapable of taking advice, that in itself can be a red flag because you want to be persistent as a founder and you want to believe in your idea and in your vision. Absolutely right. Please be persistent and don't let anyone stray you from that. But there is a difference between being completely dumbfounded and stubborn and like just running into a wall without even looking for the door versus being persistent, right, about your grand vision. And the thing is that the market and the customers will show you and give you the feedback that you need to like get to that vision, but you have to adapt. And yeah, again, like usually you don't end up with the same solution that you initially had in mind that you then actually scale and turn into money. And another red flag, and this is hard for pre-seed or like really early stage, but let's say latest after pre-seed round or seed round, definitely the cap table and the equity distribution.
Let's dive into that.
I do not want to see a founding team that is over diluted in an early stage, and it ties back into what we said before. If you, let's say, go into like a seed deal and the founding team not even owns 50% of the company anymore, and you actually have those cases in deep tech a lot, where you have like a university spin out and the university already takes like 25 or more % on the cap table, that is a big red flag for an investor, and it makes the startup incredibly unattractive because and for a simple reason, not because investors are greedy and they want to have more of the cap table, but ask yourself, how motivated will that funding team be for the next 5 years if in, let's say, 3 years, if they raise the next round or the next 2 rounds, they only own 10% of their company anymore, right? Like it actually ties into that. You want to see people motivated to build this out over the next 5 to 10 years. So if they are already over diluted at an early stage, how big is their motivation? Because ultimately it puts them into a situation where they are sort of like an employee in their own corporation, and it's almost like they have RSUs of a big corporation versus they actually control the dynamics of the company. So I think Equity dilution is a big red flag. We have the founding team. Yeah, and I think coming back to design thinking and lean startup, and you guys actually mentioned that, and this reminds me of Web3. So usually you follow a pretty simple process that is exactly like an iteration loop, right? You always go back and you return, and you go back and you return. Usually you try to validate the problem first, then you validate the solution, and then you come into like product and market, right? So you don't even talk about product or market in the first loop. You talk about problem and solution. You first look at the problem. And I feel like, especially in Web3, and this is another red flag in itself, because this doesn't require any revenue. This doesn't require any hard traction. This doesn't require a balance sheet. None of that. You don't need a P&L for that. Show me that there is at least a critical mass of people that have that problem that you're trying to address.
Mm-hmm. The amount of solutions that were created in Web3 just because we can was insane. I mean, I think everybody listening back to this call or on live now can reflect on one they've seen cross their timeline that goes, what is that doing for me? And I think that that's something that it's so simple, but we lost it in this new wave of innovation. And I'm not sure where it got lost. And I love your point about the coachable founders there, because I mean, something that has stuck with me forever is you do not know what you don't know. Find the people that when you're in the room bouncing off the walls, trying to find the door, the person can tap you on the shoulder and be like, the door's right there. Because it's going to save you so much time. And time, I think, is one of the other things that is your biggest enemy as a startup founder. We're constantly competing against it, to earn time back to help grow your business. If you can get time back to just find out where to go solve for a solution versus trying to come up with a variety of different solutions, it's incredible. And I don't know why that isn't the standard. I mean, I am so excited when I see a founder or a deck come my way and it's got advisors, mentioned, and they've got some type of sounding board that is helping them accomplish their mission. Because, as Jim McGuire said in the chat here, when management already knows everything, that's probably an issue.
Yeah, honestly, couldn't have put it better. I think that those are some great things to look for when you're kind of kicking off that due diligence process, right? Especially when you're leaning into the founders, the founding team, getting into the cap table even, right? Who's going to be able to make those strategic decisions around the direction of where that organization is going? And Sebastian, I know you echoed a point, Tien, that you brought up as well, which is, if you can prove that you're solving a meaningful problem that has a lot of customers, those dollars are going to flow in regardless. And I think that was even stated at Startup Grind Global from the Y Combinator guys that were present there as well. They were like, so many startups and so many founders spend hours on their pitch deck, hours trying to fine tune their early financial projections.
Startups aren't pitch decks.
Yeah, realistically, you need to prove that you're solving a meaningful problem at the end of the day, and people are going to buy it, and dollars are going to flow in. So with that kind of being said, I'm curious to delve a little bit more into, Tien and Sebastian, your due diligence process. I mean, I know that it's a little bit, sometimes secretive and proprietary. That's what gives us an edge. But curious to get your perspectives here on, in addition to just the founders, the founding team, what are some of those like early questions that you ask from a due diligence standpoint, whether it's around their customers or the industry standard markets? Curious to get what's, those like top 3 questions of yours are, when you go into the room as an investor for that founding team. And maybe Sebastian, we'll start with you here, and then Tien, we'll kick it back over to you.
Yeah, so I don't have a set of 3 questions that I always ask. So it's so usually maybe let's start with how it usually works, right? Usually the first question that I ask is, can I have the pitch deck? And then I take my time to look through the pitch deck, and that is usually when the actual questions for due diligence come up. But maybe even tying back into like the red flags, because something popped into my mind. One, are you doing this full-time? Is your entire team full-time? Because it actually is sort of a red flag. And this is conditional red flag. if you have a part-time founder, don't get me wrong, there is nothing wrong with that. But if you are a part-time founder trying to raise venture capital and like trying to raise 1, 2, 3, 4 million without even sort of like showing your skin in the game by saying, hey, I believe so much in this, I actually want to do this full time, and like I bootstrap this to a certain degree of maturity, it's difficult. So that also applies to the team, right? I had like I had calls when I asked like, hey, how many people are on there, right? Well, like we have 2 founders, and then we have this other person, and then we have like 2 or 3 others that like are sort of in. So I was like, so yeah, but how many are full-time employees? Like how many people are actually like working on this full-time? Well, the 2 founders, and the rest, sort of like comes in and goes whenever they feel like it and whenever they have time, which that is not a scalable base for getting things out the door and like shipping things and pivoting quickly. So that is probably one of the first questions that I'm asking. And another question is, when we talk about the problem, does the founding team have domain experience and domain authority, and is it a problem that they experience themselves? And don't get me wrong, it is not necessarily a red flag if you're not solving your own problem, but it absolutely helps if you're solving your own problem, because at least now I know that you've experienced this, and you probably have like a good couple of years or months experience in doing it, and you know what annoyed you, and you're trying to like find a solution for yourself. So at least you already have the first validation point that there's one person who has that problem, that is you. So that already helps. That is another question that I usually ask, which also ties into the experience of the team in that specific vertical. And I think the last question, this was actually a question that I wanted to throw in there and get all of your guys' opinion. Fundraising in itself is not a goal of a company, right? Fundraising is a tool to get to a goal, and your goal is to build a business that ideally is profitable at some point. And in these days and times, I'm also like debating with myself, given everything that I see in the market with AI and all the tools that we have, like low code, no code. And trust me, like I'm no stranger to this. Usually, since I always deal with deep tech and like frontier technologies and like sophisticated software solutions, that is usually where I get ideas myself, but I'm not a software engineer.
You're like, so I didn't even think that was possible.
Completely annoys me that I can't solve my own problem because I can't code. But this is what I'm trying to get at, is like, there is like a plethora of low code, no code solutions out there. And there is great tools that I've used myself to scribble out like a user flow to actually mock up an app, create a click dummy and stuff like that. All of that with zero coding knowledge. So the thing is, going to an investor with a pitch deck without anything built and saying like, hey, I need $1 million to build this. Well, where is your skin in the game then, right? Like if you are not willing to at least invest $500 in low code, no code tools to build something out, why would you expect me to get the conviction to give you an amount of X to build this if you don't even like, invest in yourself? So question to all of you, like, how do you perceive like bootstrapping these days? Because I do feel that we're getting back to reality, and that the demand for founders to actually, show something in the age of AI and in the age of all of those tools is not uncalled for. And you actually have a plethora of options as a founder to build something out without spending $500,000 or $1 million into the development.
And that's something that I think is the new, I wouldn't say new debate, but it's something that I've seen so much, is a team building a technical solution without that domain expertise, without any traction in terms of the development, going that we're going to build this, and they don't even know who's going to build it. There's so many things you can do as a team. If you're not a technical founder, like you're saying, using some of these available AI or low no code platforms, or even just building out these narratives, user stories, extreme use cases of how this solution might impact someone, and then interviewing some potential development teams. knowing that you've got at least some teams in the pipeline and you've talked to them to get an understanding of what this is going to cost, the resources that it takes. Like that's that skin in the game that you're talking about, Sebastian, where I don't need to be a technical founder to do that. I can do that on my own, and shows that we're working in that direction where even if it doesn't exist today, it gives me the confidence that you know where you're going and that I can support you on that journey. So I think that's so interesting there. And, I just wanted to echo some of those thoughts.
Yeah, I couldn't agree more. There's so many, just like the access to information is exponential these days. So is the access to resources to develop something. I know I've got a friend who's working on an application, and he's been able to get a wireframe and a handful of workable code written using ChatGPT or one of these AI models. Like it taken him tens of hours, but still, I know that he's driven, he's dedicated towards it because he's been able to implement that time. And kind of, I'm reflecting on, from Sebastian, your question on bootstrapping. I'm reflecting on a startup that we actually passed up on because they were asking for funding, and one of our questions was, well, how much have you put into this far? And they all said nothing, $0. And we're like, okay, well, why would we give you dollars if you're not even willing to bet on yourself a little bit and put some skin to the game? So definitely I'm a big fan of bootstrapping. Definitely I'm a big fan of utilizing the resources available to get a workable product that you can then demonstrate and get some initial user traction. But with that, Tien, I'm curious, anything additional that you would add from your due diligence process that maybe we haven't addressed just yet?
No, I mean, you guys have been pretty thorough. I think, in terms of evaluating the team, yes, skin in the game, critical. Advisors, critical. Coachability, self-awareness, super critical. I think the other piece, I think Sebastian mentioned, is the utility, of the product itself. Is this sort of a toy or a science project, or is it actually solving a real problem? And how big is that problem? And then the third thing is how scalable. So if you can demonstrate or prove some of those things out, you might get some, that'll improve your chances of getting some initial seed capital to pursue it.
Yep, absolutely.
And obviously, we're talking about investing and evaluating these disruptive companies. And we've been talking a lot about Web3, but I'm curious, Tien, we'll start with you. What are some of the things that you're really excited about when it comes to some of these emerging, disruptive trends that are taking the fundraising space by storm? Is there anything that's got your attention that you're like, this area is just super interesting right now, and anytime something related to it comes across my desk, I'm taking more than a second look?
Yes, I mean, in the healthcare side and the life sciences. So we're about half of our companies now. Initially, maybe 10%. Half are now probably life sciences companies. Some of the breakthroughs are just mind-boggling, to be honest with you. I mean, the impact on the human condition is going to be felt for generations, and we're going through a real golden age of biotechnology renaissance. No kidding about that. I know that is not the topic of this.
Well, hold on, that's fascinating. We can dive into
that. But that's quite thrilling. There's just a lot of innovation. There are cures for cancer, cures for AIDS, cures for so many ailments, longevity applications. The stuff that Elon Musk is doing with Neuralink. Yep. So a lot of it's going to be driven by the cheaper AI, and the cost of technology is dropping. It's allowing us to do things that, exponentially more impactful things than we were able to do, a generation ago. So that's something that's really exciting for us. And we are going to continue supporting a lot of life sciences companies because of that.
That's interesting, because we just had a life sciences and healthcare, tech startup reach out to us, and we were chatting with them, and the solution that they were working on, Luke, we were like, what? This is going to change the world. And you've got a team behind it that can actually do it. And it sounds like you're seeing that over and over again, which gets me really excited, because like you're saying, it's that golden age, that renaissance of innovation happening in healthcare that can impact the planet in ways that we on this call cannot comprehend yet. And I think that is something that, in a time where the world's a little bit dark, it's great to see a lot of light that's coming and solutions that are going to impact so many. And so I am very excited to hear some of the progress that you're going to be making interacting with some of those teams. But Sebastian, I got to toss it to you, man. Is there anything that's exciting, anything that's coming across the desk that you're like, anytime I see something in this industry, it's got my attention?
Am I allowed to say AI? I feel like you can't have,
even though it's frowned upon. Somebody can.
I feel like you can't have VCs and startup panels these days without mentioning AI at least 20 times during the session. Otherwise, it's not
17
cool.
more to go.
So, but in all fairness, no, I think actually to what Tian was just saying, like, and this is where artificial intelligence really comes to play, right? Because it just decreases the time of developments and like the velocity of those developments, because out of a sudden you have the computing power and you have the algorithms, and I mean most of it is machine learning, but let's just subsumize it and summarize it under AI. To like basically backtest like different formulations of like a vaccine and shit like that. Like, I mean, we've all seen it with COVID, right? So all of that happens in the background, and it just allows us to advance at a higher velocity. That being said, though, I like to stay in my comfort zone, and I just don't know enough about biotechnology to really like look at that either as an individual nor.
Tian's got you excited.
No, I don't. I mean, it's very analogous to our conversation about diligencing Web3. These guys, that's the other thing I like, the intellectual stimulation. You have founders and founding teams and advisory boards they're all top-notch, world-renowned scientists with PhDs. And, I love being the dumbest guy in the room. I mean, I really love it because I'm a sponge. So, in terms of opportunities, I'm sure we're going to strike out too. I have no doubt. But, but some of these I think could wind up being great too. But, yeah, it's hard. My point earlier about investing in areas that you kind of have knowledge of, that's what I would do, continually do. It's sort of like some of these bets that are so tempting to make, we will make them. But it's much better. It's more comfortable for me to invest in an industry or a sector that I have some knowledge of. I know customers, I know people. It's a lot easier to diligence that way.
Or at least you're passionate about it. That gets you excited, where you want to invest the time and resources to go gain that domain expertise. In an area like AI, Sebastian, where it's still somewhat newer, I'm assuming that you've been in it for some time, hearing your background, but it's one of those things that your passion for it is helping you go above and beyond these individuals that are just, scrolling through their feed and see a video every once in a while. You are in there messing with these GPTs, trying to figure things out, meeting with these founders. There's some element of passion that goes into, kind of that domain expertise that needs to be, weighted in a little bit. And I love to hear that your passion's AI, Sebastian, because don't worry, as much as the whole industry is going that way, some people need to build expertise in there. And from chatting with you, man,
honestly, like I feel like the area that fascinates me more, the most, just personally, is the whole field around data economy. And I know that AI is sort of like adjacent to that, but I feel like it's like a platitude, and like I don't even want to say it, but data is the new oil. I know we've been hammering down that path for the last 5 or 10 years almost, but it's more true than ever, right? Like if you look at like everything that's happening around us and like the startup scene at large and the VC scene, like name one groundbreaking hardware product, right? Like biotech is definitely one of these areas that has a huge impact on humanity without being software only. But like, just speaking of actual products, right? Like I'm almost getting bored, like hearing about the newest iPhone or like the newest Android phone, because great, it's slimmer, it's faster, it's, I don't know, the battery is bigger, great, but like it's not a groundbreaking revolution anymore, right? Like the revolution was the first iPhone, or the conversion from like basic cell phones to smartphones. And yes, we are old enough to actually have witnessed that transition live. And I'll tell you that actually was a real game changer, because it completely changed consumption habits, and it truly like gave people a new playing ground. But I think the data economy at large is going to play a major role for enterprise and also for consumer grade sectors moving forward. So anything that goes into monetization of data, protection of data, is something that I'm generally interested in, and I know that it's extremely important for enterprises as well. Leveraging thinking about cybersecurity moving forward, but also thinking about AI at large, right? And one last thing to know, yes, I'm playing around with AI, and it comes due to personal curiosity, and I want to educate myself about it. And I mean, frankly, I've been looking into AI solutions back in 2017, 18, before it was cool and before everyone was talking about. Back then it was computer vision in the automotive industry, right? Self-driving cars, object recognition, using different sensors to actually give a car the information that it needs to drive by itself. We just weren't hammering down on the AI terminology back then, but it literally, I mean, it is the same concepts. But a lot of it, what I'm seeing right now is it's a lot of people, a lot of information that gets populated through social media. It's not really groundbreaking information. It's just people that try to make information more accessible, but it's not necessarily artificial intelligence has evolved in the last, let's say, 2, 3, 4 months, meaning it has evolved in the background, but what you see people posting about, it's basically just a new verbalization of something that was already enabled before, right? And I think what's really interesting is that we're now seeing this breakthrough in the consumer layer, where people can play around with GPTs, and it's just made a frontier technology incredibly accessible. And that is great. That's a great time to be alive. And I hope that we also see that moment in Web3, because quite frankly, I can't think of any Web3 application that achieved that leap so far.
Yeah.
No, I totally feel you there. It's in that age of information. We have so much that it's hard to even find it. And these individuals, a lot of these, quote unquote influencers or content creators, the reason they're building these followings is in an age of information where it's everywhere. They're the ones that are helping tell the story for the reader and the normal everyday person to digest it. And it's such an interesting time right now that we're in of where this is all going. I mean, heck, look at this web series. The reason Luke and I were trying to put this together is because we've had so many people reaching out to us saying, why does this matter? How is this going to change the way that I'm going to interact in X industry or with X person, or just with how I'm handling my everyday life? And I think this conversation, Luke, probably could go for another 3 hours if we wanted to. Crazy to think that we're already, over an hour here.
Yeah, I couldn't agree more. I think that we've got a bunch of great nuggets here today, great insights. One additional piece I wanted to add of what fascinates me about this current time that we're in is that whether it's you're looking at biotechnology or life sciences, which is an industry that I focus in a lot from a privacy data protection standpoint, or if you go into energy or artificial intelligence, these are theories and problems that have been trying to be solved for the last 80 to 100 years, right? If you're looking at it from an energy perspective, you had the fission and fusion reactions utilized in the 1940s to help create the atomic bomb. Now we're utilizing those same reactions to harness energy and use as renewable nuclear power. Blows my mind. You talk about AI. You have Alan Turing, who's basically arguably the father of AI, who was preaching these topics in the 40s, the 50s, the 60s, and now we're 80 years later, and finally technology is here to enable it from a consumer standpoint. So we're definitely just at the tip of the iceberg. There's a lot of things that are going to continue to develop in the next 6, 12, 24, 36 months that I'm sure we can circle back on this conversation and have a whole bunch of more topics to discuss in the near future. But with that, I do want to be cognizant that we are right up here a little after 6:30. And so with that, I've got one final question for our guests here. And Sebastian, we'll start with you, and then Tien will have you wrap us up. But if you could recommend or give, a tangible takeaway to our audience today, maybe the 1 to 2 things to take away from our conversation. We got both investors on the line as well as startup founders, entrepreneurs. What would you give them from our conversation today? What are some of those tangible takeaways that they could take from the conversation and implement in their day-to-day tomorrow? Sebastian, we'll start with you.
I think one of the key takeaways, albeit maybe not new for everyone, but still, like, I mean, in the early stages of building a company, it's team above everything, right? And I think that's, if you are a startup founder, the nugget that you should take with you is like, how can you show that you are the right people for the job? I think that's the most important thing. And in these days and time, I know that we are all asking for traction, and we like had you put it right, kind of like it's almost like a chicken and egg problem, right? Like, so you need money to build traction, but you need to show traction to get money. So how do you solve that dilemma? I think that's also another thing. Like, be creative, not only in your idea and show that your idea is innovative, but also be creative of how you can show that people actually want your idea and that there's actually traction, right? Like, so meaning use low code, no code tools, like create like sign up lists, create wait lists, use social media to your advantage, like bring it out there. Try to maybe find influencers that would like show your solution for free if they can get it for free afterwards if you build it out, whatever, right? Like, be creative of how you can show that you have traction without requiring that 1 million. And I mean, granted, if you are in like biotech, or if you are like in deep tech, or if you're building a robot, yes, you need money to build it. I get it, and we all get it. But also there are different funding vehicles for those specific niches, right? Usually you have government programs, you have grants, you have universities, yada, yada, yada. So there is other solutions for those specific fields. But if you are just building a software, usually there is a lot of ways how you can growth hack yourself without requiring a lot of money. So I think that's another key takeaway. Like, basically, show people why you are the right people for the job, and show people that you're building something that is actually meaningful and that people need.
I love that.
Yeah, absolutely. Tian, how about yourself? What are some takeaways for our audience?
Yes, I was thinking about that. Well, in honor of the great Charlie Munger, who passed away last week, I was quite a disciple of him and Uncle Warren Buffett. I would say follow Charlie's advice, which is to stick to the basics, to do sustainable and scalable things, things that will be lasting and tried and true, as opposed to chasing the hottest thing. I know Web3 is one of the sexiest segments of our economy, and there's a lot of flash and a lot of shiny objects, but try to find, if you're an investor, those opportunities that have a higher chance of success because they have a better team or a true use case that's filling a big need in the marketplace. And as a founder, I would also stick to the basics, and that means focus on 2 things. One is, building the best team you can possibly build and operating, as Sebastian said, in as agile and as light a manner as possible. And number 2, even more importantly, is to focus on the customer. I think, because if you have a customer and they're happy, you have a nice business. I know, Jim, you had put in the chat about doing pilots, and I think, Connor, you responded. I mean, pilots are a great way to test, market acceptance, and to build your MVP, and to find product market fit. Exactly. So I would focus on those 2 things, and generally the rest will take care of itself. Hopefully the market will come back, the capital markets, in the next 2, 3, 4 years, and you guys will be well positioned to take advantage of it. So I want to wish everybody good luck, and thank you for joining us today. It was a real pleasure to be part of this.
I mean, Tian, Sebastian, we can't thank you enough. I mean, this was an episode that will be packed with great takeaways for all of our listeners. I know Luke and I even have some notes and takeaways for ourselves. So if you're listening here and you're telling me that you didn't learn something, listen back to the recording that we're going to get ready to post here before the end of the week. All of these are recorded. All of these are posted on the Startup Grind YouTube channel. So stay tuned, give us a follow. And I hope you follow this story, because this has been a fantastic episode with two individuals that I'm assuming if you haven't read about them yet, you will in the near future. These are two individuals that just shared knowledge bomb after knowledge bomb and are helping pave the way for innovation moving forward by helping put these good teams together, complete that process to make sure that that team can interact with that technology to build that beautiful trio of solutions that's actually going to change the world. So thank you for everyone joining us for another amazing episode of Bridging the Gap to Web3. And thank you, Tien and Sebastian. We look forward to following your journey and chatting again here in the near future.